Fellas, you know Degree Cool Rush deodorant, right? Well, last year they changed the formula, and guys were mad about it. One dude even started a petition. So guess what? Degree heard us, admitted they messed up, and brought the original Cool Rush scent back exactly how it was. And it's in Walmart, Target, and other stores now for under $4. So grab some and remember why its cool, crisp, and fresh scent made it the #1 men's antiperspirant for the last decade. Degree Cool Rush is back, and it smells like victory for all of us.
This program is sponsored by the investment advisory firm Vestry, which is solely responsible for its content. Opinions and advice do not necessarily reflect those of station staff, management, or ownership. Content is believed to be accurate but not guaranteed. Nothing discussed here should be considered personalized investment advice, nor solicitation or offer to buy or sell services, products, or securities. It is general money knowledge, information, and opinions. You should always seek out qualified tax, legal, or investment professionals for specific advice and guidance.
Radio for a really great future. We're talking real money.
Now, I try to keep up with the industry, both the investing advice industry, the financial talk radio. So I listen to financial talk shows, and I try to keep up. I occasionally go to Google and look up what's new in the financial money radio arena, and I just saw this headline. It's in various publications. This makes me feel old. Headline, Lil Wayne,
yeah.
it's L-I-L. Not Lil Wayne,
yes.
It's Lil Wayne. Lil Wayne announces Young Money Radio. Now, what is the first thing I thought? When I heard that, I went,
perfect.
He's doing radio for kids.
Yeah, little kids.
On money.
Yeah.
No, it has absolutely nothing to do with money. It's just Lil Wayne's channel. On his first show, he premiered Hoodie Baby's mixtape. It's just a rap channel.
But as long as you can listen and watch it and understand it, then you're not old. But if you can't, then
can't.
Okay.
I played it and I went, oh no, I don't like it.
Oh.
I just don't like. I don't know why. I like all kinds of. I mean, I listen to younger alternative indie music.
I haven't listened to anything new since
rap.
about 1977, so you're way ahead of me
and
there.
I think the names are just funny, like Lil Wayne and Hoodie Baby. Just spell it out. It's okay. Anyway, that got me to thinking, though, about talk radio, about why we listen to money talk shows. Why we listen to money talk radio shows, why we watch
We,
CNBC,
as in you and I, or everyone?
As in the greater society of humanity.
Yep.
Why do we listen to the financial talk shows? Why do we listen to or watch the shows? Why do we read the financial magazines? Why do we do that? And that I'm going to put that question to you listening, and you can call us. I'd love to know more about why you listen, because maybe it could help us make this show better for you. What do you want from us? But I'm going to throw it to Tom. And this is not rhetorical.
Okay.
Why do you think you've been in this business for weeks now?
Don't call me old, darn it.
No, he's a youngster
just
getting started.
There's
in the
a
industry.
little bit of gray popping through the blonde there. Okay.
There is
or is it the other way around?
There isn't a single shred of blondness left.
I'm going to get
Apparently,
that fixed.
You look in the mirror under yellow lighting. You need to get rid of that 1910 bulb that you still have screwed above the sink.
Speaking of old.
That glows yellow.
So
your
question...
What is that, a Casio calculator watch? What is
like
that? It's like a Casio calculator watch.
So you want to know why I think, okay, we'll take that topic on, but you can call us and tell us, too, and how we can do better.
I want those listening to call us and tell us that.
Okay.
I want to know what you're trying to get out of these programs, like ours and the many others. They're all over the flipping place on the weekend. 877-397-5666. I don't care what you want to get out of Young Money Radio, though. I really don't.
Tom and Don are talking real money.
Here's another brief interruption. I am surprised at how much people still love their magazines, their print magazines. The vast majority of the most popular magazines on the planet have millions of print subscribers and only a few 100,000 online subscribers. I learned people like reading on paper, and because of that, I've decided to create a brand new magazine for real investors to help you become a real investor. It's called Real Investing Journal, and it's full of just that, real investing information, the science of investing, the proven ways to make money long-term without gambling. There's no business news. There's nothing about speculating. There's no lifestyle stuff. It is all about investing all the time. It's a full-color magazine. It's printed every quarter, and it's going to cost $25 a year is all. That's all, $25 a year. But here's the deal. If you become one of our charter subscribers, we'll lock in $15 a year, and while supplies last, you'll get the very first issue in addition to your next year. That's a deal. $15 a year, and if you don't like it, I'll give you your money back. That simple. So go right now to realinvestingjournal.com/subscribe. You need to add that /subscribe. realinvestingjournal.com/subscribe and sign up for the charter subscription rate of only $15. You save $10 and you lock it in, and you get an extra issue. And you need to do it now because I know we're going to run out of the extra issues, so you better hurry. Go to realinvestingjournal.com/subscribe. realinvestingjournal.com/subscribe. You'll like it or your money back. And speaking of back, we're going back to the show.
Your guides to a really great financial future. Tom and Don are talking real money.
Apparently a friend, and I'm going to use that term loosely, a friend of the show, loosely, wrote Tom during the break, texted him during the break to get Tom off the hook because I guess he figured Tom really
I wouldn't be able to come up.
Answer.
I do actually have an answer.
Come up with an answer.
But I'll read some of his answers first because it's pretty good. He said people listen for 3 reasons. Validate their existing philosophy. That makes sense. See what the other half are doing. Yeah, that's you kind of want to see, what am I missing? Out of a genuine sense of wanting to learn. Yeah, there's some of those people out there. And
some of those, yeah.
And then he said, speaking of old, he said in the case of our show, they can't reach the radio and have no choice. So, ouch. Here's my take. Most of you.
I'll take your take.
Because if you go when we do a class, when we do a money show, when we do American Association of Individual Investors, when we actually get out and talk to you one-on-one or in a group, most people, what they want to know is how to get rich. Most. Okay, I'm telling you. You can call and contradict me, but
no, they can contradict you. I'm not. I'm just going to tell you. Then you might as well stop listening.
Well,
we're not going to get you rich quickly.
No, not quickly, but we can number one depends on your definition of rich. Right?
Yeah.
Remember, people in the 1960s thought $1 million was rich. Today, they think $1 million is rich. So, and there's been quite a bit of a thing called inflation in between.
But you're not going to become a billionaire unless you're saving millions.
Oh, I knew you.
Well, so we're going to column.
Yeah, so the column from our friends at CNBC. I love these headlines. Love these headlines.
Again, so-called friends.
Yeah, so the headline is, billionaire investors didn't get rich by using index funds. This from, by the way, a billionaire hedge fund manager whose name is Leon Cooperman. He was defending the industry.
Wait, okay, so, then what I haven't read the article, but I'm guessing what he's going to tell you is start your own hedge fund. That's how you become a billionaire.
Because you can charge people 2% a year plus a percentage of the profit, assuming there are profits. Wow. I mean, but see what the reason I get angry when I read a column like this is because to most people read that and think, oh, then I don't need index funds. I need somebody who's going to be smarter than the market. I got to, what's the next big trade? What's the thing I have to own? And the reality is to be super rich, billionaire. Yeah, buying index funds probably won't get you from 0 to $1 billion unless you have a long time to do it. And you can add a lot to the portfolio. But billionaires do use index funds every single day. And the smarter billionaires have given up on hedge funds, especially Mr. Cooperman's hedge fund. Because billions have been pouring out of these things because people figured out, as you said, they've been great for the people running them, not so great for the people who have invested in them.
I figured out how you could have see, we love the past tense word.
Only thing we can
don't know
use.
anything about the future.
Yeah.
I figured out how you could have gotten to be a billionaire using index funds.
Okay, give us the numbers.
Use a globally diversified, if you had used a globally diversified fund over the past 30 years, and you put $1 million in
30 years ago,
and $20,000 every month.
Every month. That sounds like a lot of money.
It's a lot of money. You would have hit $1 billion by now. There you go.
Start with $1 million, add $20,000 a month.
Add $20,000 a month, which means really you need to have a job that earns you probably at least $30,000 a month because you got to pay taxes.
Mm-hmm.
And you then live.
So you're adding $250,000 a year for 20 years plus the $1 million. Yeah,
there you go.
Okay.
$1 billion. Wait a minute. Oh, I'm sorry. It's $10 million.
Oh, you got to start
Never mind.
There's a small
problem
with the decimal there.
Yeah,
we're going to want to have that number right.
The numbers are starting to get so big at that point.
No, I hate this advice because what you hear.
At $1 million, you only get to $100 million.
Oh, okay. Because what you hear is don't use index funds. That's the message. No. You need to hire smarter people.
And yet, who is the best known guy who started Microsoft billionaire investor or guy who started Amazon or guy who started Apple or whatever. Who's the biggest billionaire investor, best known billionaire investor?
I think he still lives in the same house he bought 40 years ago or something.
And if you ask Warren Buffett today, Mr. Buffett, I am a regular person who works at one of your meatpacking plants or your insurance company or whatever you own. I work there. Should I pick stocks like you do to become a rich beyond my wildest dreams down the road, or what should I invest in? What would he tell those people?
He is going to tell you to use an index fund. He's told his wife to use an index fund after he passes away.
You can't beat the market. No. You can't. Want to? Maybe. Can? No way.
And
no how.
You asked why many people are listening. Many people do listen for that. Many people come to classes for that. Many people listen to other radio programs for exactly that. I want more than my neighbor. I want more than the guy sitting in the cubicle next to me. And if I just listen for a while, if I find that little edge or find that person, I'll end up with more.
The text message that we received about the question led me to an idea. I think it's time that Talking Real Money moves into the 21st century. You know how we're going to do it? Look here, Twitter. I have my Twitter account open on the screen.
Oh, you can put something up there right now?
So if you don't want to call and share your reasons why you listen to, read, and watch this stuff, why, tweet me. I'll read them on the show. You can tweet the show now. We're going to have official show tweeting starting right now. At Don McDonald is my Twitter handle.
Hashtag. No?
Oh, we should hashtag it.
Yeah.
Hashtag why I listen.
Okay.
There you go. Hashtag that.
And we will talk about it.
I'm not sure how this all works, but we're going to find out.
You got somebody in the neighborhood who's a little 30, 40 years younger and come in and help you?
I don't tweet very often, but I do have an account.
All right.
And I have 67 followers. Yeah, 67 followers.
I think I have like 4. I've only done one tweet ever. So.
Oh, no. I have 173 followers.
Whoa.
I'm following 67 people. I have 173 followers.
Okay. Well. All right. So what else is out there in the new world, the brave new world of financial radio?
Financial radio has gone so far downhill over the past 10 years. It's truly sad. When I started in financial talk radio in the 80s, there were the Dolans.
Yep, they're still around.
Terrific. Yeah, they're still kind of around.
Yeah, barely.
You sort of had Bruce Williams.
Yeah, a little bit.
But he did some financial advice. It wasn't great financial advice. It was good life advice. Bob Brinker. Bob's still around on the weekends, but Bob
hard
gives
to find.
weird advice. And Bob gives weird advice. I mean, sometimes it's good because he publishes market timing.
Yeah, he's a timer. Yeah.
He's a timer.
Okay.
We had that guy Don McDonald.
Don?
And you know what's funny about all of those shows is every one of those shows, the hosts were paid a living salary for doing those programs and not selling their soul. Now, the only way to get on the radio, and everybody does it today, it's Edelman, Adam Bold.
It's all over the place. Yeah.
They're all over the place. You got the online trading guys. You've got the indexed annuity guys.
A lot of that.
They all pay to be on, and so therefore there are these gigantic conflicts of interest in these programs. I mean, the guys who sell indexed annuities their conflict is, if I sell you $100,000 indexed annuity, I make $10,000. Yes,
small conflict.
Really hard. If I sell a market timing program that can cost you like it's free first, then it's $300, then it's $3,000, then it's $33,000. It goes. If I'm selling you something that can make me $40,000, I'm going to push that really, really hard. And we like to think that maybe we lean a little bit less conflicted about our position on this show. We try on a daily basis, on a showly basis, on a weekendly basis, not to push you to work with us, even though we are investment advisors. So therefore we have a conflict.
Yeah. So let's go back to that for a minute, because that's we do have a point of view. I went to a graduation party and there was a young guy there in his late 20s. He'd studied finance, some investing, etc. And I said, well, there really is only one way to invest. We touched on this last week, and he said, that is amazingly arrogant. I go, well, there's only really one way that's supportable, that has evidence, where you can go back and say, this is what the science show. Everything else is purely speculative. And I don't care who writes otherwise. So we do have this belief system. What we try not to do on the show is call us Monday morning at 7 a.m. We'll be ready to help you. We try and avoid that conflict. But we do have a conflict because we really want you to believe this. And for those of you who want to, we want you to be clients. That's our conflict, unquestionably.
And but again, we're not doing the hard press, the full court press every weekend to try to get you to do that. True. Unlike, there are some stations, not this one, thankfully, but they're loaded with these conflicted shows, and those bother me. And as a matter of fact, in today's Wall Street Street Journal, Jason Zweig talked about the inherent conflicts in any job.
Yeah, and I want to talk more about that because
it's any compensation agreement.
What you're seeing now is people saying that, and it's right. He points out it's right on the internet. You come to us, we give you conflict-free advice. Conflict-free advice, not so much. We'll touch on that.
Does that mean they're not involved in a war in Central Africa?
Exactly.
That kind of conflict-free?
It's a good start.
877-397-5666 is our phone number. Give us a call. If you need some help with your money, call us for selfish reasons, too.
Tom and Don are talking real money.
Let's make a deal. We need reviews for our podcast to make it more popular, and you'd probably like a free year of Real Investing Journal. So, I'll trade you a year of Real Investing Journal through a $15 coupon code in exchange for a review at iTunes for the podcast Talking Real Money. Here's how you get your coupon code. Go to iTunes, write a review of Talking Real Money that at least goes into a second line, drop me a note at don@talkingrealmoney.com, along with the text of the review. I'll go check. As soon as I see it there, I'll send you the coupon code, and you can order the only real investing magazine, Real Investing Journal, and get the first year free. That's all there is to it. Just send me the copy of your iTunes podcast review to don@talkingrealmoney.com, don@talkingrealmoney.com, and I'll give you a coupon worth $15 off Real Investing Journal. Now, this is a limited time offer, and there's only one per email address, so go ahead and submit your review to iTunes, and then send it to me, don@talkingrealmoney.com.
For your real life and real future, Tom and Don are talking real money.
So we were talking about conflict-free financial advice. By the way, if you think you're getting that, call us and tell us. I want to know who's providing that. No, I really do, because our friend Jason Zweig wrote a piece about it in the Wall Street Journal today, and in it he said, and correctly so, there is no conflict-free advice. It does not exist. There are those in the industry that are now telling you, yeah, there's a website. I'm not going to give it out here, but there's a website where he found where he went there and looked around and they said, hire us because it's conflict-free advice. And then he asked the firm, and what is the firm's? I love this. The firm says, well, it is conflict-free advice, except that we do get paid if we sell this product more than that product. That sounds like a conflict to me.
The conflict, I mean, even if their argument is, their reasoning, and here's what it says. This is one of my favorite companies to harass, LPL. Used to be Linsco Private Ledger. We talked about them last week.
Yes, we did.
LPL Financial, this is a direct quote from their website, LPL Financial understands that providing Americans with unbiased investment advice is critical to their financial security. Because the firm has no proprietary products to sell.
Oh, yeah, that's it.
LPL Financial Advisors can provide, get this word, truly objective, conflict-free advice and investment recommendations. As long, folks, this is not a quote anymore, as long as there is a commission involved, there is a huge conflict of interest. Huge.
And as Jason went on to point out, both, in fact, around the products that you're selling and the fact that if I'm moving from one brokerage to another one and get you to come with me, you get paid a sweet amount for that.
Oh, a lot. Let me tell you, I went from Dean Witter to a regional firm in Colorado called Betcher. I had a very nice book over at Dean Witter, and we called it our book.
Yep, your clients.
Book of clients. I brought most of those with me, and they gave me, for the first year, 100% of every penny in commission I generated during that first year. Usually the split is 60 to the firm, 40 to the broker, something like that.
Oh, they want those assets.
Or even less.
Yep.
Or even less. So and then when after I was at Betcher and was getting ready to leave, I was going into radio, Linsco Private Ledger approached me. They were going to give me a regular payout for the rest of my life of 90%.
Wow.
Because they didn't do anything for you.
You still getting that check every month?
I'm not getting that check anymore. I haven't gotten that check in too many years.
All right.
I'm not giving away my age again.
Yeah.
But there is no such thing as conflict-free advice, and it's very conflicted if they are in a position to accept commissions. And please bear in mind that most LPL firms, I just looked this one up. They're in Bellevue. They are an LPL firm, so that means they sell products on commission. They also are a financial advisor, an investment advisor, through an investment advisory arm, so they can go back and forth between fiduciary and not fiduciary. But get this, their investment advisory arm, for the first $1 million invested, charges 1.875% for the first $1 million.
Expensive.
That's a lot of money. 877-397-5666.
Tom and Don are talking real money. money.
Hi, brief break time. I'm Don, and I really wanted to share this with you because this is something I'm really excited about. I have taken much of the work that we do for our online Real Investing Journal and put it into a quarterly magazine that is, I have to say, pretty good and pretty cheap. And it is the only publication I can find anywhere that is totally devoted to real investing. You will find no business news there. You will find no lifestyle information. You will find no hard news, political news, speculation stuff. It's all about the science and the process and the discipline of real investing, and it's a way to keep you on track toward a better future. It comes out 4 times a year, and it's going to cost most people $25 a year. That's all, just $25 a year. But because it's brand spanking new, a limited number of people can become charter subscribers at the lifetime price of $15 per year. Plus, I'll get you a copy of the very first issue as a bonus while the supplies last, of course. So here's all you need to do. Just go to realinvestingjournal.com/subscribe and subscribe. And you'll start getting it in the mail every quarter. If you're one of the first 200 or so to subscribe, you'll also get the very first issue as a bonus. So be one of the first to get the very first magazine ever about investing and nothing but investing. Real Investing Journal, and you can subscribe right now, really easy, realinvestingjournal.com/subscribe, realinvestingjournal.com/subscribe. Now back to the show.
Your guides to a really great financial future. Tom and Don are talking real money.
By the way, I'm not just picking on Linsco Private Ledger, or as they now call themselves, LPL, because it's catchier. I pick on everybody. I pick on Morgan Stanley. I pick on Merrill Lynch. I pick on Ameriprise. I pick on Voya. I pick on Ed Jones more than anybody else, only because they're so ubiquitous.
To go back to finish the thought before we go to the phones, Linsco Private Ledger, LPL, yes, I hate to tell you, they do have conflicts of interest. Number 2, even if you hire them just for the wrap program, for lack of a better expression, in other words, that they don't charge you commissions, to pay them 1.9% a year is pretty high. That's a lot of money.
It's 2% on the first 500,000 and 1.75% on the next 500,000.
That's just a lot. And then you throw in the fund expense. And we went through this with somebody in the office the other day that we figured out they were paying about 2.5% a year. Let's say the market, if you do really well, makes you 7% a year minus 2.5%. Well, you can do the math.
It seems like a third of your return.
Yeah, that's a lot. That's a lot of money. So expenses do matter.
877-397-5666 is our telephone number. And Tom, you're up. Welcome to Talking Real Money.
Well, thank you very much. My name's Tom, and as of last Friday, I'm a retired psychiatrist.
Oh, please don't analyze this. We can't take it. I don't think we can take it.
That kind of show.
My thoughts on your motivation for listening to talk radio, I think, parallel why people send money into advisory services that pop up on the internet. And I think there's 2 factors: fear and greed. Fear.
I think you nailed it.
There you go.
You were good at your job when you were a psychiatrist, weren't you?
I think it's still in my blood.
Yeah.
And the other
Fear and
question,
greed.
I did have a question about what you thought about closed-end funds that specialize in preferred stocks like Nuveen or Hancock or
Okay, so
Battery.
Tom, you were good at one part of your job. This part you were not.
You were a great psychiatrist.
Yeah,
but
you should have read the body language of the person selling you that type of fund. Number 1, Don, you want to tell people what a closed-end mutual fund is?
I would love to do that. A closed-end mutual fund is it's a conglomeration, a portfolio of assets of a certain kind. Let's say preferred stocks. It's a portfolio of preferred stocks. It is offered to the public and then closed.
So with
you can't buy into it again.
Open-end mutual fund you can buy every day because they can issue new shares. You simply buy the fund, you get the underlying assets. Therefore, pricing looks a lot different. So with a regular mutual fund, at the end of every business day, you know the price of what that fund is worth. Different with a closed-end fund.
And some of the issues with closed-end funds, Tom, one of the biggest issues is the fact that its pricing can get out of whack because it trades on an exchange it's a lot like an ETF, except without the liquidity in the portfolio. You can have huge discounts or premiums. Usually you have discounts that don't recover. The other problem with these is that the internal expenses are high generally, higher than just indexed type products. And the other thing is that you're you're making very specific bets. For example, on preferred stock. Preferred stock is a hybrid between common stock and a bond. It's somewhere in that crazy middle ground. But the problem is it really doesn't have the growth benefits of being in stock, and it doesn't have the protection of being in bonds. You're the second to the last creditor before common stock, and because it's not ownership of the company, you really don't have that growth component that you do in common stock. I don't like preferred stock as an investment. I think it serves some very specific purposes for high rolling investors, but for your average investor, I would be all over something that was all indexed and dirt cheap and open end and liquid and always at net asset value every day.
Yeah, that gets I guess the question would be to anybody, why do you need or to put in your portfolio?
Correct. These are always sold to people.
So we wouldn't be recommending that generally. So that would probably be something to avoid. Get it out of your head, maybe, Tom. I don't know. I was trying to come up with a bad. Anyway,
you were trying to come up with a bad psych joke. Yeah. 877-397-5666 is our number. Jeff, you're next. Welcome to the show.
Hey, Jeff, how can we help?
Well, I think, maybe a couple of questions, but I will give you this much information. I'm 59, no longer married. I have $150,000 sitting in a bank account that gives me 1.5%, I believe it is. I'm waiting to buy a new house, and I've come across a company named Primerica, and I have a friend of mine who is involved with them. And the second half of this question then is, I have a whole life $50,000 life insurance policy that my friend is trying to indicate to me that through Primerica, I could get a much better deal through them with better payout at the end. And by the end, I don't mean necessarily me dying, but was my understanding of whole life is if I wanted to borrow money out of my money that I put in, I'm basically giving myself a loan that I have to pay back with interest. So
we're going to take the
second one first. I can deal without the first.
Okay.
You do the second one first,
well,
and I'll come back to Primerica.
No, you go ahead. You start. I mean, because you're just over there jumping up and down. I'm gonna gotta let him go.
Okay, Primerica.
We've talked about Primerica on the show before. Yeah.
Yeah, Primerica used to be a company called A.L. Williams, and then they became Primerica, and then they were sold to one big bank, and then they were sold to American Express, and then they've been all over the place. Or no, that was Ameriprise.
Yep.
Primerica became part of, what was the bank? Big bank. Anyway, Primerica and Ameriprise and many of these are they are high commissioned houses that sell. The concept initially was buy term, invest the rest. But the problem with Primerica is that their term tends to be very expensive, so that it pays a nice commission to your friend, and they tend to sell you very expensive, both upfront and along the way, mutual funds. And generally, and no slam on your friend, but generally these people they're not great advisors. They tend to be people who are salespeople.
Well, they have a high turnover, I believe, because we looked into this at one time, and little experience when it comes to the kind of the planning aspect of all of this. At the end of the day, when you're going to hire somebody, you want somebody who's going to do the planning, getting you from 59 to 89 with enough money. The products that these recommending may or may not get you there, but the bigger picture for me is, are you getting that kind of help? And my guess is probably not.
And no. And please, this is going to, ruin your friendship once you find out more about Primerica. Primerica is still to this day, your friend got MLM'd into this.
That's what we're getting to. Yeah.
They became part of someone's downstream. This is like Amway for mutual funds. And I say that disliking Amway a lot. And it's Herbalife for mutual funds. And I say that disliking Herbalife a lot because I dislike all MLMs. I dislike MLMs because they're patently unfair to those at the bottom of the food chain. They end up supporting all the people above them, which it's not a normal corporation. Some people say, well, it's just business, folks. No, that's taking advantage, folks, of folks. And I really do not like Primerica, and I don't think you'll like the products long term, and I think you'll end up getting terrible advice.
Tom and Don are talking real money.
Here's another brief interruption. I am surprised at how much people still love their magazines, their print magazines. The vast majority of the most popular magazines on the planet have millions of print subscribers and only a few 100,000 online subscribers. I learned people like reading on paper, and because of that, I've decided to create a brand new magazine for real investors to help you become a real investor. It's called Real Investing Journal, and it's full of just that, real investing information, the science of investing, the proven ways to make money long-term without gambling. There's no business news. There's nothing about speculating. There's no lifestyle stuff. It is all about investing all the time. It's a full-color magazine. It's printed every quarter, and it's going to cost $25 a year is all. That's all, $25 a year. But here's a deal. If you become one of our Charter subscribers, we'll lock in $15 a year, and while supplies last, you'll get the very first issue in addition to your next year. That's a deal. $15 a year, and if you don't like it, I'll give you your money back. That simple. So go right now to realinvestingjournal.com/subscribe. You need to add that /subscribe. realinvestingjournal.com/subscribe and sign up for the Charter subscription rate of only $15. You save $10 and you lock it in, and you get an extra issue. And you need to do it now because I know we're going to run out of the extra issues, so you better hurry. Go to realinvestingjournal.com/subscribe. realinvestingjournal.com/subscribe. You'll like it or your money back. And speaking of back, we're going back to the show now.
For your real life and real future, Tom and Don are talking real money.
Matter of fact, I don't know how these companies stay in business with the internet. Just go to the internet and type in Primerica MLM, and all these things will come up. Primerica, is it a scam? Go read about it. And if you want to get an honest education about how to invest, how to pick indexed style funds, how to be a better investor, Tom and I are teaching a series of, we're doing 2 classes, 3 days, coming up in Linwood, Tukwila, or Bellevue in May. Sign up right now and save $10. You got to get your tickets now, though, at TalkingRealMoney.com.
Let's make a deal. We need reviews for our podcast to make it more popular, and you'd probably like a free year of Real Investing Journal. So, I'll trade you a year of Real Investing Journal through a $15 coupon code in exchange for a review at iTunes for the podcast Talking Real Money. Here's how you get your coupon code. Go to iTunes, write a review of Talking Real Money that at least goes into a second line, drop me a note at don@talkingrealmoney.com, along with the text of the review. I'll go check. As soon as I see it there, I'll send you the coupon code, and you can order the only real investing magazine, Real Investing Journal, and get the first year free. That's all there is to it. Just send me the copy of your iTunes podcast review to don@talkingrealmoney.com, don@talkingrealmoney.com, and I'll give you a coupon worth $15 off Real Investing Journal. Now, this is a limited time offer, and there's only one per email address, so go ahead and submit your review to iTunes, and then send it to me, don@talkingrealmoney.com.
Reality radio for a really great future. We're talking real money.
Need a little help with money or investing? Tom and I are here to do that. At 877-397-5666, 877-397-5666. And Tom, you alluded to this earlier about Primerica and their pay per person. I believe this was as part of a settlement several years ago about their recruiting practices, and they have to, every year, they have to disclose on their website, on Primerica.com, how much money per year their representatives make on average. Do you know how much? Do you want to guess how much they make?
I would have because they have so many. They add like thousands a year and they lose thousands a year.
Yeah, but
it's a crazy number.
Person, the average income, this is their total income before taxes, $6,100.
And that tells you everything. Do you think that person is working full time for you? Do you think that person is invested in this industry? Do you think that person is paying attention to all the things they need to do? Or do you think that person is simply seeing you, oh yeah, you have $150,000, I can help you with that, and it's a great product to sell you into? It's the latter, guaranteed.
The people, bear in mind, of that pool of money, the people at the top of the pyramid, and it is a pyramid, it looks just like a pyramid, they're making a lot, the lion's share of that, they're making millions and millions of dollars, which leaves the people at the bottom way below $6,000. They're not going to make a career out of it. What they're going to come in and do is take advantage of a couple of their friends and family members, and then they're going to drop out of the business. They're going to quit the business. They're going to go get a real job.
And I got my $6,100. Thank you.
Or $3,000.
Whatever, yeah.
877-397-5666 is our phone number. Gary, you're up first.
Thanks for waiting, Gary. How can we help?
Okay, thanks for taking my call. I'm 65 years old, and I've been investing over the past 40 years, and this has definitely been a learning process every year. But my question that I have for you is, I actually got 2 agents right now, and one agent is telling me, he says, because I'm going to be retiring probably in about the next 3 years when I hit 68, he says, you got a lot of A shares and a lot of volatility. And he says, through EFTs, we could probably get that volatility down to, say, like 5 to 7% versus the 7 to 12.
Okay, can I get you to stop there? Can I stop you 1 second? So when you say agent, are we talking insurance agent?
No, they're regular. I don't know if I can tell you the name of the companies or not.
Go ahead.
Welcome to the great United States of America.
Jones,
Yes.
It's Edward Jones, and then I do AXA.
Okay, I'm going to answer part of this. I'm going to let Don answer the second part. First of all, there is the relationship between the type of investment, an A share, and you said EFT. I think you mean ET, Exchange Traded Fund. There is no relationship between the volatility of that type of those two types of investment. In other words, you could own an A share mutual fund that would be wildly volatile. That could bet on small companies in China or something. I mean, so you could own the same thing in an ETF. So those two things, if somebody told you we can reduce your volatility by moving you out of an A share into an ETF, you either misunderstood or he or she misspoke.
Yeah. Which is by the way, the latter is the more likely of the two scenarios. Because I want you to understand something, Gary. When I came into this business in my 20s, and I'm closer to you than my 20s by a huge margin. When I first came in, I was a salesperson, really. I was a stockbroker for Dean Witter, huge firm, but I was a salesperson. And the people who come into this business have little or no knowledge of investing. And I'd lean more toward no than little in most cases. So really, they're feeding you a line they've been given by the company. But let me tell you what the common denominator is here between Ed Jones and AXA, which is part of Equitable. They are both of these people are commissioned salespeople. So the AXA person desperately wants to get you.
Here's another brief interruption.
Away from Ed
I
Jones,
am
on which you've already
surprised
paid
at how
Ed
much
Jones
people
commission.
still
And
love their magazines, their print magazines. The vast majority of the most popular magazines on the planet
of course it is.
have millions of print subscribers
and
only a few 100,000 online subscribers. I learned people like reading on paper, and because of that, I've decided to create a brand new magazine for real investors to help you become a real investor. It's called Real Investing Journal, and it's full of just that, real investing information, the science of investing, the proven ways to make money long-term without gambling. There's no business news. There's nothing about speculating. There's no lifestyle stuff. It is all about investing all the time. It's a full-color magazine. It's printed every quarter, and it's going to cost $25 a year is all. That's all, $25 a year. But here's the deal. If you become one of our charter subscribers, we'll lock in $15 a year, and while supplies last, you'll get the very first issue in addition to your next year. That's a deal. $15 a year, and if you don't like it, I'll give you your money back. That simple. So go right now to realinvestingjournal.com/subscribe. You need to add that /subscribe. realinvestingjournal.com/subscribe and sign up for the charter subscription rate of only $15. You save $10 and you lock it in, and you get an extra issue. And you need to do it now because I know we're going to run out of the extra issues, so you better hurry. Go to realinvestingjournal.com/subscribe. realinvestingjournal.com/subscribe. You'll like it or your money back. And speaking of back, we're going back to the show now.
Your guides to a really great financial future. Tom and Don are talking real money.
You know that really famous painting by Edvard Munch called The Scream? The guy with the hands on the face going, ah!
That's where you are right now?
I want you to prepare your Scream face after I tell you a little something. Be prepared. Speaking of AXA, and I was looking back at my notes on Gary's call, and it's they wanted him to move from A shares to ETFs. Yep. I'm thinking, okay, maybe they're using an ETF portfolio that they manage as a registered investment advisor.
And in that case, you would be buying generally a fairly low expense product, right? Because ETFs should be lower expense.
Yeah. So I'm giving them the benefit.
Yeah.
I went to AXA's disclosure form online, their ADV Part 2.
I'm putting my hands to my cheeks.
At advisorinfo.sec.gov. First, you're going to love this. When you read an ADV Part 2, this is the disclosure form that if you guys deal with an advisor of any kind, you should look them up online. Look up their fees at least.
And they got to give you one too, by the way, if you hire them.
Yeah. Where on what page generally do the fees land in most of the ADVs you've looked at? Pages 3 to 6 or 7?
It's hard to know because some of them are big and some of them are small, but okay, I'll go with you.
In AXAs, they start at page 30. You don't get to the fees until page 30. And then they give you 2 full pages of fees of the various advisors they can use. And the fees range, they're as high as 2.3% per year.
That's 2.3 to AXA, and then you have the cost of the product they use in that portfolio.
And who does AXA use as their broker-dealer?
Don't know.
LPL.
Oh, perfect. So So what we're trying to tell you here is, in simple math, you're probably going to pay somewhere around 3% a year to others. We talked about this last hour. You start with 7, you take out 3, you can see that you're beating inflation, but not by a lot. Let's put it that way.
And as I was telling you all before the break, or Gary, if you want to try and find a fee-only advisor, one that has a style reasonable to us that is based on academia, go to DFAUS.com. DFAUS.com. And in the right-hand corner, it says, what does it say exactly? It says, find an advisor near you. Click on that, type in your zip code, say advisors who primarily use dimensional funds. You're going to get better funds that way. And type in your zip code, and you'll get a list. Call those people. Look up their forms ADV.
And I can almost
tell you that we're the only ones.
Almost guarantee you they will be less than 2 point something a year.
I've looked them all up, and every one of them is the most expensive is far below that. So 877-397-5666 is our phone number. And Rod, you're next. Welcome to Talking Real Money.
Hey, Rod.
Hi. Love your show.
Thank you.
So I have several questions, but you probably want me to just ask one.
You hit us. We'll see what we can do.
We'll do the best we can.
What is your feeling about when financial planners that run the Monte Carlo simulation? Should we put any stock in that, the probability they come up with?
Well, here's what you need to know about it. A Monte Carlo is it shoots everything out in a big spread, right? It shows you worst case, best case. There's value to that because what you really want to know often is, do I have enough money and will it sustain me for the rest of my life? It is one method of doing that. We happen to use a couple of other ones. We use a simulation through a piece of software called Cashflow Fingerprint, which I think is a little better because
it's a variation on the Monte Carlo because you're still simulating, and you're still simulating all manner of possible outcomes. They just take into account more historically.
Historical, because what a Monte Carlo just sort of says is best case, worst case, in between has all these possibilities. The Cashflow Fingerprint says, here's what history has done, and here's here's what taxation has been. So it's a little more specific. There's other planning tools. I don't hate it, but it wouldn't be my favorite. Yeah, I wouldn't say it's my favorite.
But there's value to it in that it gives you some probabilities. But remember, probabilities are just that. Probabilities, not absolutities.
What's your other question, real quick there, Rod?
Well, I know that it sounds like you're generally down on annuities, but there is a Washington State annuity that is available for teachers under the TERS Plan 3 that offers an automatic 3% COLA every year. Plus, if you choose a joint survivorship and the survivor, the beneficiary passes away, it can be up to a single life.
I'm not down on that. I am not. No. I want to be clear. I think that's
an appropriate use for an annuity.
It is, and you're taking the money, you're putting it in something, you're getting paid. Most of the other annuity products are not like that. They promise something they can't deliver, and that is, kind of market-like returns over the long haul with no market risk or little market risk.
What the insurance industry's done, Rod, is they've taken the term annuity, which used to only apply to you giving a cash amount to an insurance company, and they promised you a lifetime income. That used to be what annuities were, and that's all they were. Of course, to make more sales, they've messed that up. They've modified it and come up with they come up with variable annuities, equity indexed annuities, all of these various products that turned a simple concept into something we hate. We hate the complexity. We don't hate the simple. If you get you want an absolute income for life, there is nothing wrong with an immediate annuity, an income annuity. Just make sure it's one of the good ones. And the Washington plan, from everything we've seen, this new plan looks like a pretty good one.
Yeah, so again, that wouldn't be a bad place to go, especially if you're trying to generate income for a long period of time. Often people come to us and say, I want to leave money. I don't want to spend all this down. There might be a reason not to invest it in an annuity. But generally,
that's the downside of these, is that when you hand your money to the annuity and annuitize it, that means turn it into an income stream, your money is gone. You die tomorrow, it's history. You're not going to be able to give it to your heirs. The insurance company basically, an annuity's a bet. Here's the best way to look at an annuity. The insurance company is saying, we've crunched the numbers on all human beings. We bet you that you're going to die sooner than later, and we're going to get to make a lot of money on your money. every once in a while, someone is an outlier. They're outside the norm, and they live for 110 years, and the insurance company loses the bet. But they've done the math, and they're pretty sure they're going to win the bet more than they lose it. Now, occasionally the insurance industry is wrong, like they were with health, long-term care insurance.
Indeed, yes.
They made their bets were totally off on that, and that's why long-term care policies have almost vanished and premiums have gone through the roof.
Whole different deal. So I get, and here's the other thing I do want to point out. Generally, if you took that same amount of money that you were going to get by putting it, instead of putting in an annuity, if you invested it in a moderate portfolio at a low cost, you end up with more. Generally, but you took the risk of putting
taking
stock.
on the risk, rather than
so it's not a risk transference the way that annuity would be. So we want to be careful people understand the difference there.
That's why we're here every Saturday, to help you understand the difference, to help explain this. That's why you need to call us at 877-397-5666, Saturdays at 2 Pacific, or at noon Pacific, 2 Eastern.
Hi, brief break time. I'm Don, and I really wanted to share this with you because this is something I'm really excited about. I have taken much of the work that we do for our online Real Investing Journal and put it into a quarterly magazine that is, I have to say, pretty good and pretty cheap. And it is the only publication I can find anywhere that is totally devoted to real investing. You will find no business news there. You will find no lifestyle information. You will find no hard news, political news, speculation stuff. It's all about the science and the process and the discipline of real investing, and it's a way to keep you on track toward a better future. It comes out 4 times a year, and it's going to cost most people $25 a year. That's all, just $25 a year. But because it's brand spanking new, a limited number of people can become charter subscribers at the lifetime price of $15 per year. Plus, I'll get you a copy of the very first issue as a bonus while the supplies last, of course. So here's all you need to do. Just go to realinvestingjournal.com/subscribe and subscribe. And you'll start getting it in the mail every quarter. If you're one of the first 200 or so to subscribe, you'll also get the very first issue as a bonus. So be one of the first to get the very first magazine ever about investing and nothing but investing. Real Investing Journal, and you can subscribe right now, really easy, realinvestingjournal.com/subscribe, realinvestingjournal.com/subscribe. Now back to the show.
For your real life and real future, Tom and Don are talking real money.
That announcer lady was running at me full speed, and I got so confused. Call us at 877-397-5666 between noon and 2 on the West Coast, or if you're listening to the podcast on the East Coast, call us between 3 and 5, and then you fill in the gaps in the middle.
Saturday only.
Saturday only.
Yeah, there you go.
Noon to 2, 877-397-5666. I think I got that right.
Yep, because it rings at my house on Sunday mornings. I don't want to do that.
Oh.
Yeah, it's frustrating.
I'll give you Tom's cell.
Please.
Okay, what are we doing now? Oh, we're going to Jim. Jim, you're next. Welcome to Talking Real Money.
We're supposed to go to Lee, actually.
Lee, I'm sorry. I was looking at the wrong screen. Lee, you're next, not Jim. Jim, you're after Lee, though.
How are you, Lee?
I'm good.
Good.
The other fellow you answered kind of the same question. I'm in the state Washington PERS 2 plan, which is pretty close to 3. And my question was the same. I could buy from 0 to 60 months of additional service credits, which at the top end would cost me $200,000 for about $920 a month. And my question was, you kind of answered was, I know it's sort of an annuity, but the caveat that I wondered if it's worth it is that it can escalate up with up to a 3% cost of living on a yearly basis.
And let me just stop you there very quickly, because this is you've struck on this exactly right. The question to you is, how comfortable with the risk are you? In other words, if you just want to hand the money to somebody and get the money back, then that's not a bad way. To try to get in and analyze whether buying those extra credits makes sense or not, that's not something we can do on the show. That takes quite a bit of financial planning. But generally, if you're looking for risk transfer,
the part is what intrigues me, because so if I spent the $200,000, I can roll it right out of my deferred comp at no taxes. It goes directly into the extra buyout. That would still leave me. I'm 60. I'll be 63. I have no debt. I have one daughter. When I'm going to leave her a house that I own, she's going to have that for inheritance, and I have my house with no debt. And I'd still have $500,000 in the market on top of that. So
yeah. Well, but here's really
a good way
the
to
gist
hedge your
of
bet.
well, Yeah, right. It's a bet hedge of sorts, but bear in mind that inflation, and this is a great little number. If you had invested $1 in 1926 and just gotten the rate of inflation over all those years, you'd have $13 today. Not a lot of dollars.
Instead,
if you invested that in the stock market, it's about $5,000.
And if you invested that in small company stocks, you're over $20,000.
Right.
Pretty easy to see.
So
risk.
Stocks keep up with inflation. That long term.
The cost of living part is the only part that I didn't know it, because on a regular basis I'd say no, but since that cost of living is built in, that kind of helps with the inflation part.
Right, but stocks, if you are a patient investor, and not everyone is, if you're one of those people who says, stocks go down, but they've always gone back up, and you believe that they will again, then stocks have always given you that inflation adjustment. They always have. The average annual return on stocks from 1929, I believe, is global stocks, about 11% per year, somewhere in that ballpark. That's inflation. That's a nice return, and everything that was lost to inflation included. So it's a personal call. It's not a financial call. It's really more of a personal call.
It's not a real bad move then, I guess. Kind of what I heard you say.
No,
I mean,
not
if
at all.
I want to be
It's
conservative
personal.
And maybe I buy 30 months or something, because I still have $500,000 in the market. So that should keep me up with in that aspect.
I think you understand the gist of it. It is not a purely financial decision. It is a personal feeling, comfort, lifestyle decision.
Yeah, I mean, this is the trade-off. You're handing the risk to somebody else, knowing that you're likely to get less. That's it.
Right.
It's as simple as that.
The trade-off.
Yep.
Let's see. Well, no, we better not.
We'll go to the calls at the bottom of the hour here. So yeah.
Yeah, after the bottom of the hour.
I do want to mention very quickly that again, if you hear the show and you know who we are and you know that we manage money for a living, we need more people to work with us.
Are you trying to solicit
this
employees
is the
again?
Tom Job
It didn't
Fair.
work last week,
Well,
but
it's not over. 1 week.
If you're looking for a job in the financial services industry with an honorable, honest firm,
it's up on our website, right?
It's up at the website.
Yeah, okay. Vestry.com.
You go to Vestry.com, and there's a link there to apply for jobs available at Vestry. And that's going to always be there because Vestry's growing, and I believe probably will continue to.
Tom and Don are talking real money.
Here's another brief interruption. I am surprised at how much people still love their magazines, their print magazines. The vast majority of the most popular magazines on the planet have millions of print subscribers and only a few 100,000 online subscribers. I learned people like reading on paper, and because of that, I've decided to create a brand new magazine for real investors to help you become a real investor. It's called Real Investing Journal, and it's full of just that, real investing information, the science of investing, the proven ways to make money long-term without gambling. There's no business news. There's nothing about speculating. There's no lifestyle stuff. It is all about investing all the time. It's a full-color magazine. It's printed every quarter, and it's going to cost $25 a year is all. That's all, $25 a year. But here's the deal. If you become one of our charter subscribers, we'll lock in $15 a year, and while supplies last, you'll get the very first issue in addition to your next year. That's a deal. $15 a year, and if you don't like it, I'll give you your money back. That simple. So go right now to realinvestingjournal.com/subscribe. You need to add that /subscribe. realinvestingjournal.com/subscribe and sign up for the charter subscription rate of only $15. You save $10 and you lock it in, and you get an extra issue. And you need to do it now because I know we're going to run out of the extra issues, so you better hurry. Go to realinvestingjournal.com/subscribe. realinvestingjournal.com/subscribe. You'll like it or your money back. And speaking of back, we're going back to the show now.
Reality radio for a really great future. We're talking real money.
And you said it didn't work. You said it wouldn't work. You said my job pushed. There was already a person that called during the break could take your job. Boom, just like that. That quick, see? Huh? Yeah. Who's funny now, right? Okay.
Got a tweet.
Oh, you did? Nice.
I did. I got a tweet from a guy who wants to know how to invest. He just basically says he has $350,000 in Vanguard index balance in American funds from a job and has $500 in his IRAs. And he says, okay, to move all to Vanguard? Sure.
Yeah.
There you go.
If you know
Wasn't that
nothing,
a quick and easy answer?
If you know, they have a service where they'll help manage your money. I think it's pretty inexpensive. It's like 0.3 of 1%.
Even then, you know what you ought to do, Russ? Go to talkingrealmoney.com and to Vestry.com and take the risk
yeah.
quiz.
That's a good
You
idea.
can also get it at TalkingRealMoney.com. Take that risk quiz. That's going to show you what your level of risk is, and that'll give you an idea how much you should have in equities and how much
Then
you should
go
have
do
in
it.
bonds, and go do it at Vanguard's great. We love Vanguard. Unless you need somebody to help you out and allocate it for you, then you get an advisor. Otherwise, Vanguard's terrific. 877-397-5666. Jason, you're next. Welcome to Talking Real Money.
Hey, Jason, thanks for hanging on. How can we help you?
I'm currently on the Dave Ramsey plan. I'm to the point now that I'm thinking about doing retirement. I'm 39 years old, and I know from the research that I've been doing that I want to do Roth. And Dave said to do good growth stock mutual funds. What do you guys think about that?
Well, Dave, I think, doesn't Dave have one mutual fund that's made 14% a year or something forever?
No, listen.
That was he was pitching that a while back, wasn't he?
No, he doesn't. No,
Okay.
Dave was of the opinion that the average annual return for any idiot going into any stock portfolio is going to be 12% per year.
That was it. Not true.
Wrong.
Yeah, nobody makes 12%.
Here's the thing. I love Dave's debt reduction fervor. Okay, Dave? He always slams us because we tell him when it comes to investing, he's not very good. But let me just tell you, when it comes to investing, he's not very good.
But let's talk about why, too. So if you called his organization and you said, I need somebody to help, he will gladly send you to somebody who is not a fiduciary, somebody who uses generally high expense products and uses actively managed funds or ETFs.
Yeah.
Generally.
He calls them endorsed local providers, or now he's got a new service called SmartVestor. All of these people pay Dave a fee.
A lot.
To get leads from you, and they're all commissioned. And the reason Dave pushes commission salespeople is because this is Dave Ramsey's personal bread and butter. So don't do it. If you're going to start building, you're going to start your own Roth IRA. How much are you thinking of putting in this every month?
I'm going to be maxing it out, the $5,500.
Okay, and do you have that today?
Oh, yes, sir. I'm actually got my house going to be paid off next month.
Okay, so and do you have it? So if you have $5,500 today,
he's 39 years old.
You could still make a contribution for tax year 2016. So
I believe so. That's what they were telling me.
You can.
This is going to be so easy. You're going to go to Vanguard.com. It's going to take literally 10 minutes. Open a Roth IRA, right?
Okay. Yep.
Then they're going to say, and they'll help you figure out how to get the money there. They're very good at that. Then you're just going to buy one mutual fund. It's going to be this is going to be like 1/5 of the cost you'd pay somebody at Dave Ramsey for this help. And the one fund is V as in victory, T as in Tom, W as in world.
W as in world.
I wasn't a military guy.
You stalled there for a second, but okay, you recovered.
Yeah, S as in Sam, X as, I'm not supposed to say this, X as in xenophobic, X as in X-ray, VTWSX. That is one mutual fund that owns a globally diversified portfolio of stocks. It owns, I think, about 7,000 companies globally.
7,500 now.
And you get it at what, like 0.25? It's so ridiculously cheap.
0.21% per year.
There's no commissions. I mean, this is so, and you take that.
Compare that to the Dave Ramsey's favorite fund group, which is the American funds that are sold only through his brokers. 5.75% to get in there, 0% to get in at Vanguard. 5.75 versus 0, which would you rather pay?
And the expense ratio.
The expenses are at Growth Fund of America, they're 0.66. On their international funds, they're more like 0.8 or 0.9. So put the two the international and the U.S. together, you have about a 0.75.
Say 0.75%
per year. 0.75% versus less than 0.25% per year.
No brainer.
No load versus 5%. 5.3.
You just have to
5.75.
Yep.
It's
an index fund that owns the world.
Looking at those, they seem to be super cheap. Now, how do they take their fees out of there? Do they just do it up front?
No, there's no commission. That's what Don was saying.
Every day they take a little smidge out.
Oh, okay.
Over the year, it adds up to 0.21% of your investment.
Less than a third of what we believe you'll pay at American funds. It's just, and no commission. I mean, this is.
And no commission.
And Dave's going to tweet to you
and
soon.
you'll own 7,500 stocks.
Great fund.
Whereas the Growth Fund of America owns, hold on if I can get there before the break. Can he do it? 249 versus 7,500.
Half right.
Which would you choose? I know which one I choose. 877-397-5666.
Tom and Don are talking real money.
Let's make a deal. We need reviews for our podcast to make it more popular, and you'd probably like a free year of Real Investing Journal. So, I'll trade you a year of Real Investing Journal through a $15 coupon code in exchange for a review at iTunes for the podcast Talking Real Money. Here's how you get your coupon code. Go to iTunes, write a review of Talking Real Money that at least goes into a second line, drop me a note at don@talkingrealmoney.com, along with the text of the review. I'll go check. As soon as I see it there, I'll send you the coupon code, and you can order the only real investing magazine, Real Investing Journal, and get the first year free. That's all there is to it. Just send me the copy of your iTunes podcast review to Don@TalkingRealMoney.com, Don@TalkingRealMoney.com, and I'll give you a coupon worth $15 off Real Investing Journal. Now, this is a limited time offer, and there's only one per email address, so go ahead and submit your review to iTunes and then send it to me, Don@TalkingRealMoney.com.
Your guides to a really great financial future. Tom and Don are talking real money.
All right, Tom. Since I've decided to become an even bigger twit than I already was,
yes,
I have gone to Twitter. Right here, I'm in my Twitter account. I've gone to @DaveRamsey. There you go. There he is on the screen, smiling at me right now. Here I go. I'm pushing the button. I've never pushed this button before. The button says follow. Like, oh, I'm now following Dave Ramsey. I can't wait. We're gonna have an argument one of these days.
I undoubtedly. Dave has gotten into it with several people in our industry about investing. Yeah.
That now that I'm following him, when he talks about his ELPs, I'm gonna probably respond because I can't help myself.
An ELP being
Electric Light Philharmonic.
No, come on.
No, endorsed local provider.
Yeah.
I thought it was like a rock band from the
let's
80s.
just say it. Local salespeople. Good Lord.
Right. They're all
in a term that we can
commissioned
understand,
salespeople.
and they should say that too, by the way. This industry would be a lot better off if people just had a little more transparency around how they're getting paid, what they're doing with other people's money.
Oh,
I don't know why they're so
worse over at Dave Ramsey because they've got a new term for them, and they just started this, and it really annoys me. And I just put it away. I need to bring it back up. What was the name? Dave Ramsey.
Well, should we go? We can go to the phones while you're messing around online. All right.
I gotta get it while my mind is on it. It is called. Wow, I had it right here. I'll find it. All right, we'll go to the phones. 877-397-5666 is our phone number. John, you're next. Welcome to the show.
Hi, John.
Hi, guys. How you doing?
Good.
Good. Hey, thanks for taking the call. I just wanted to follow up. I was listening to the previous caller who was a Plan 3 member in the state retirement system, and he was asking about annuities and purchasing service credit, and just wanted to provide a little more information. The annuity that I think he was asking about that's offered to the Plan 3 members, it's called the TAP annuity, and it does actually pay out if the member doesn't live long enough to receive the amount they purchased in for. It will pay the difference between what they received and what they purchased in for to their named beneficiary.
That is an unusual because it's a state program. That's a different. Most annuities we were talking about just in general. Yeah, but thank you. That's absolutely right. There is a cash value with this kind of a program, but that's because it's a funded state program. Most annuities, the immediate annuities we were talking about, kind of mixed into that whole conversation. They're just bets with insurance companies. But you're absolutely right. That is something we should have mentioned.
Okay, I just wanted to say.
Appreciate it. Thanks for the call. 877-397-5666 is our phone number. 877-397-5666. They've changed the name of endorsed local providers.
We're back to Dave Ramsey now. Okay.
Yeah, I think one of the reasons they changed it is because the endorsed part, they were getting in a lot of trouble because that implied a tacit endorsement, and a lot of these people's sales practices are abhorrent and unendorsable.
Dave didn't want to endorse them, maybe.
Dave did. I think Dave really was looking at, am I going to get sued for saying I'm endorsing these people? So they've now changed the name of the program to SmartVestor. I think they stole part of our name.
But I mean, I don't know how they can get away with calling it smart because that makes it sound again like
trade name.
But it makes it sound like you're smarter than the market. You know something. I don't like it.
Yeah, here's how it goes.
Yeah.
You fill out the form, and then 5 SmartVestor pros will call you 5.
Wow, that's a lot.
Within 24 hours.
5?
And they'll fight for your business.
That's a lot of people.
Actually, that could be fun to watch.
Maybe, we'll talk about that another time.
Stockbroker cage matches.
There's next Saturday's show filling up fast.
I'm thinking we should get all of these guys, these SmartVestor guys, we'll get them on the show at the same time and let them battle to the death.
Dun, 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 dun,
for the
dun,
commission.
Dun, dun, dun. Yeah, okay. Yeah. No.
So anyway, that's what Dave's doing now.
SmartVestor. Does it tell you what you're what kind of product they're going to put you into?
No.
Because, remember the caller was saying, well, he wants to put me in some growth stocks. That means not very much.
Here's what you send them this. You ready? This is it. Name, email, phone number, your zip code. That's it.
Let the calls begin.
And then to become a SmartVestor Pro, would you like to apply? You can apply.
I'm currently employed, but you never know.
Here's what they do to vet you. They want your first name, your last name, your email, your work phone, your street address, the name of your company, and get this, they're not looking for registered investment advisors because the next question is, who is your broker-dealer?
Mm-hmm.
Folks, broker-dealer is a giveaway term. Broker-dealer, the only people who have broker-dealers are not registered investment advisors, but registered representatives, a.k.a. stockbrokers / mutual fund salespeople. They have broker-dealers. Insurance agents, they have broker-dealers.
Where the money is held.
Right.
Yeah.
And they want to know, in what month and year did you become an investing professional? I would have, I haven't yet, but I hope to someday as a choice, but it's not one of the choices.
Yeah.
And then they want your FINRA CRD number, and this is how they vet them. They look it up and they go, do they have any complaints?
Nope.
All right, no complaints. They must be good.
And
no complaints.
there are a lot of people still in this industry that have a lot of complaints, so that is actually something.
Okay, that's something.
Yeah.
But
no,
still.
it wouldn't be how to make a decision, no.
I would not make a decision on, I want to go with them just because they've had no complaint. No.
You're going to get sold a very nice, actively managed, high-expense mutual fund with a big commission.
Most of the time, you're going because they know what Dave likes. They know what they're going to pander to Dave. Dave likes the American funds.
Mm-hmm.
So the vast majority of them are going to sell the American funds.
It wasn't an American fund. I thought he had one that made 12% a year every year. Come hell or high water.
He just says that's the market.
Okay.
The market's always made 12% every year.
He is one good trader or something. I know.
And let's assume it did happen. You're telling people it's going to keep happening. Dave Ramsey tells people to assume a 12% return going forward. Do not buy bonds. Bonds are for stupid people.
Until the market goes down 50%, then you might have wanted to have a couple.
But don't worry about it because it's always gone up 12.
Yeah, okay. It seems to me that when people question him about this, I could be wrong.
He gets very defensive.
Well, he gets very defensive, and he says, you're just old school. You don't know the new ways. I mean, you can go back, insert technology here, insert large U.S. That's always the argument. This is the new paradigm. You need to get on board. So do not buy that advice.
The reality, folks, it's the selfish paradigm. It's all about making Dave money. And I have no gripe with people making money. I like making money. You like making money.
Yep.
We all like making money. But to do it on your back, to not tell you in advance. By the way, every single one of these SmartVestor people we recommend to you pays us a fee to get your name. Don't you think he should tell you that? Let me tell you something about us. If you come to Vestry and we become your advisor, we're going to charge you a fee. Hard to believe,
shocking as that is, yes. All
and
right,
by
so
the way,
Dave,
if you want to learn,
yeah, go ahead.
If you want to learn the right way to invest, we'd like to invite you to some brand new classes. Tom's created a class on income. He's wrapping it up. He's finishing it next week.
On the plane tomorrow, I'll finish it.
I have created a lovely class on beyond indexing.
Amazing.
Indexing is great, but what's better than indexing? We'll show you that. It's in the same genre. And you can get tickets really cheap, just $5. We're doing 3 classes in the Seattle area in May. Go to TalkingRealMoney.com, okay? Thanks.
Tom and Don are talking real money.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only.
Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times.
Also, as much as you want it, no one can accurately and consistently predict the future.
So past performance doesn't tell you a darn thing about what the future will bring.
Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities.
Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor.
Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures.
That should keep the lawyers happy.